Buying the dip is one of the simplest and most popular strategies in trading, but here's the brutal truth. Most traders do it completely wrong. I have seen thousands of dip buying opportunities in my career, and most traders end up catching a falling knife and blowing up their accounts instead of entering into picture-perfect opportunities to ride the trend higher. In this video, I'm going to teach you how to identify whether a stock is truly dipping and preparing to explode higher, or whether it's about to collapse. Then I'll walk you through step by step how to capitalize on dips with sniper level precision, high reward to risk entries, and we're gonna be looking at real life examples of trades that I've taken in the past. By the end of this video, you will never look at dips the same way again, and it can completely change the trajectory of your trading career. Let's not waste any more time, and let's make you a more profitable trader. If you're wondering why you should listen to me in the first place, I have been trading dips for the last 5.5 years, and in the last 1 year, from October 5th of 2024 to October 4th of 2025, I have generated over $520,000 in day trading profits. This is my personal Schwab brokerage account, and that is a cumulative rate of return of over 346%. And if you're thinking that this is Photoshop or this is a screenshot that I edited, I'm gonna go ahead and refresh the page on my Schwab account, and if I go to my last 1 year's worth of results, there's the $529,000, and the reason I'm showing you this is to be as real and as transparent as possible. Buying the dip is by far one of the most popular strategies in trading, yet over 90% of traders have no idea what to look for when it comes to buying the dip, and frankly, most of those traders lose money trading this simple strategy. And in this video, I want to teach you the exact criteria that you want to look for when it comes to buying the dip. And I'm going to teach you how to differentiate between a high quality dip opportunity and a low quality dip opportunity that's just going to continue to trend against you. And this could be applied for day trading. It could be applied for swing trading, for core trading. This could even be applied for long-term investing, where if you like to dollar cost average into your retirement account or into your long-term portfolio, you could still apply this strategy, especially when you're DCAing into the market or your favorite indexes. This could also be applied for stocks, for crypto, for futures, for options, for Forex. So make sure you pay attention. Make sure you watch until the end of this video, because this is something that I've been trading for over 5 years. This is one of my core strategies, and I buy the dip. I trade the retracement setup almost every single day. And the first thing that you need to understand before I dive into this strategy is the idea and the theory behind price correction. And the best way that I could explain this is, imagine that you just ran a marathon. You just ran 26 miles in the New York Marathon, and you are tired. You just finished the marathon, right? Are you going to be able to run another marathon? Are you going to be able to, finish that marathon, run the 26 miles, and then immediately run another marathon? Well, unless you're David Goggins, unless you're superhuman, obviously not. You're going to need to hydrate. You're going to need to sleep. You're going to need to rest. You got to drink some water. You got to go home. You got to, visit the doctor. Maybe you have some injuries, right? You can't just run 2 consecutive marathons. You need a resting period. Well, the markets work in a very similar way, where let's say the market puts in a massive rally. The market just ran a marathon to the upside, right? The market can't just continue higher and higher and higher to infinity. No, the markets and stocks, they need a resting period. They need to correct in price. And there's 2 ways in which prices can correct. There's two ways in which prices can rest. The first way is through a consolidation, where the markets run a marathon, prices are moving up, everything is mooning, and then the markets rest and they consolidate, they base, and they rest until that stock or the market is ready to run the next marathon. And this is a way in which prices can correct, through literally resting and just consolidating. And this strategy is called the breakout. And this is one of my core strategies as well. I actually teach this strategy on this YouTube channel in a different video. So I would highly recommend watching that video as well. But the other way in which prices can rest or correct is through price action in the form of a retracement, where the markets run a marathon, they move up, buyers are buying, buyers are stepping up to the plate. And then once the market or the stock runs a marathon, it needs to cool off. It needs to have a resting period, a correction period. And one of the ways that could happen is through literally a retracement, through a dip. And this happens because buyers are probably, or buyers from down here, are taking profits. Maybe there's even some short sellers that think prices have topped and they're shorting, which is causing downward pressure. But I would say it's mostly buyers taking profits. So the markets can rest, the markets can breathe before they're ready to move up again and run the next marathon, so to speak. So a retracement is a temporary pullback before the trend resumes. And you can think of this as the market breathing. The market is resting before the next leg higher. Because if the markets are just going up and up and up and up and up, that trend is unsustainable. Nothing can just go up forever. In the same way, nothing can go down forever. There needs to be a period of price correction. And if you really think about it, this strategy is really you just trading the continuation of an established trend. Remember, the trend is your friend. I see so many traders who gravitate towards taking reversals, especially beginners. Why? And to really paint the picture here, imagine you're driving your car on the highway. Do you want to be driving in the direction of traffic, or do you want to be driving against traffic? Well, I don't know about you, but I don't want to crash head on into another car. I want to trade in the direction of traffic. Yet most traders want to, drive against traffic, right? In the same way they want to trade against the trend. It is far easier trading with the trend, especially if you're a beginner. I'm not saying don't take reversals. I'm not saying you shouldn't have a reversal strategy in your plan. I do. I actually like taking reversals. I don't usually gravitate towards them, but I do have a reversal strategy within my trading plan. However, I always prefer to trade with the trend because it's much easier. So if the trend is your friend, what is the first step when it comes to trading the retracement setup? Well, the first step is you need an uptrend or clear bullish momentum. You need to be confident that prices are going higher. I want to be trading in the direction of the trend. If there is a downtrend, I don't want to be going long. If there's a sideways trend, I also, most of the time, don't want to be going long. I only want to go long when I'm confident what the trend is. So what is an uptrend? And most of you are already going to know this. It's very simple. And by the way, if you can't tell, I like to keep my trading as simple as possible. That's what makes me a profitable trader. I don't like to use complicated indicators. I don't like to use complex strategies. I trade essentially 2 to 3 core strategies. Number 1, the retracement setup. Number 2, the breakout or the breakdown. And I also like to trade reversals at times. However, I would say 90% of the time, I am trading in the direction of the trend through either a retracement, aka buying the dip, or through a breakout. So what is an uptrend? An uptrend, it's very simple. Higher highs, higher lows. Okay, that's all you need to know. All right, we have higher highs right here, right here, right here, and we have higher lows right here. We know that the overall direction is moving higher. Now, your goal as a trader is to essentially time your entries when this dip happens. This is when you obviously want to be getting into the trend. You don't want to be getting into the trend here. Most people actually FOMO here because they think they're missing out just to see that stock move down. They sell here, it starts to move up again, then they buy either here or here just to see it move down, they sell, and then the cycle repeats. And that's how most retail traders unfortunately trade. They buy the top and then they sell the low of the retracement when it should be the opposite. They should be buying the retracement and then of course selling this point right here. Or maybe you're going for a much larger move. Maybe you're swing trading, or maybe you're holding your trade intraday when you're day trading for like a few hours and you're aiming for a much bigger gain. You could actually buy down here and then hold through all of these dips in attempt to catch a much bigger move. But you need an uptrend. If you don't have an uptrend, you need clear bullish momentum. And one of the ways that I like to see clear bullish momentum is through a bullish gap up. So what is a gap? A gap is an overnight change in price. This is when a stock opens the next day at a different price in which it closed the previous day. So let's say Tuesday, 4 p.m. Eastern, when the market closes, the stock closes at $5. And then the next morning, Wednesday at 9:30 a.m. Eastern, when the market reopens, that stock opens at $10. That difference in price that occurred overnight is called a gap. And I like to trade the continuation of a bullish gap up. And a bullish gap up gives me bullish momentum. It gives me a bullish bias. So lots of my retracement setups actually occur on bullish gap ups. And I'm going to show you a bunch of examples of that. But here's an example of a gap up. This was on plug. Oh, no, I'm sorry. This was on open, I believe, just a few weeks ago. And this stock closed right here the previous day. And then the next day it opened 29% higher right here. You could literally see the gap in price. You could see this overnight change in price. And of course, the stock absolutely mooned that day. And there was a beautiful retracement setup on this day, which I'm going to show you a little bit later in this video. But this was a gap up that gave this stock clear bullish momentum. We were gapping above resistance. We were also gapping above 2 red bars, which trapped all of the sellers who went short here or here or here. So really amazing gap up. I have other videos that go a lot more in depth when it comes to explaining gaps, but this was a really nice gap up that obviously continued higher. Here's another example. This was on rum just a couple of days ago. I will also show you this example later in the video, but it gapped from here the previous day and it opened right here, which was an around 11% gap up. All right, and this actually also had a retracement setup. It had a buy the dip opportunity on this day, but this gap up gave this stock a bullish bias, and my bias on this day was to go long. So I was looking for either a breakout or a retracement setup to essentially trade this bias on the intraday timeframes. If that still sounds a little confusing, we're going to be looking at a ton of different examples later on in this video. But essentially my point is I need either an established uptrend or I need a bullish bias. I need bullish momentum. And one of the ways I could see, bullish momentum is through a bullish gap up, a bullish overnight change in price to the upside. So when it comes to identifying a high quality dip buying opportunity, we look for specific pullback criteria. And let's go ahead and go over every single one of these pullback criteria. And from there, we're going to go to real charts and apply everything that I have just taught you. Okay, so I'm going to go through this section a little bit quicker. We're not going to be looking at examples right away. I want to show you all of the material first, and that's when we're going to go and look at examples and apply everything that you've just learned. So first step, following a rally higher, so the market ran a marathon up, we want 3 or more consecutive red bars in a row on the pullback. So we got 1, 2, 3, 4. We want 3 or more red bars in a row. Now, this is like the ideal scenario. You're not always going to get perfectly 3 to 5 consecutive red bars in a row, but this is what you want to look for. You want to see 3 or more consecutive red bars in a row. Why is that important? It's important to know that because you don't want to see Christmas lights. What are Christmas lights? Red, green, red, green, red, green, red, green, and then you move up. You don't want to see this. And the reason you don't want to see this is because as prices start to move up, if you have green bars within this pullback, well, a lot of those buyers, like think about it. If you bought it right here and then prices continued lower and now you're down on your position, and then all of a sudden prices start moving back up, you might feel the need to actually just cut that trade because you felt wrong and you were losing money, right? Or if you, especially if you bought it up here and then prices continued lower, if prices move back up, well, at that point, you might just cut your losses, or you might just say, hey, this was a failed trade. I'm going to get out break even. And you're going to have almost like layered buyers within this pullback, and you don't want that. You want there to be clear selling, okay? You just want the sellers to be taking profits before the next move up. You don't want selling and then a little bit of buying and then selling and then buying and then selling and then buying. You don't want Christmas lights, because these layered buyers could actually put sell pressure on this stock as it's moving up, where as it's moving up, these buyers sell, then these buyers sell, and then all of a sudden you have a really choppy kind of next move higher. You don't want that. You want 3 or more consecutive red bars in a row. You don't want Christmas lights. Criteria number 3, you want to look for prices to retrace into the 20-period simple moving average. I like to keep my trading as simple as possible. I don't use complicated indicators. I don't use MACD or Bollinger Bands or RSI or VWAP or stochastics or Elliott wave theory or Fibonacci. I don't use any of that. I keep my trading very simple. I only use 2 simple moving averages and volume. That is it. And the 20-period simple moving average is the ultimate trend following tool in existence. Now, pay attention to what I just said. Trend following tool. That is our first step for trading the retracement. Is we want to have an uptrend. We want to have an established trend higher. And that's exactly why I like to use the 20 MA. Now, what we want to look for is we want the 20 MA to be underpriced, trending higher. I want you to say that out loud. You're watching this YouTube video. I want you to literally say it with me. Underpriced, trending higher, underpriced, trending higher, underpriced, trending higher. We want the 20 MA to be underpriced, trending higher. And we want to be timing our entries when prices are close to or near the 20 MA. That's what we're looking for. When prices are, let's say, really far from the 20 MA, that means there's extension. Extension is the distance between price and the 20 MA. We don't want to be entering when there's a lot of extension. So you could use the 20 MA to figure out whether prices have corrected enough, whether prices are extended, or you could think of it as overbought. So the closer we are to the 20 MA, the less extended we are, the less overbought we are. And that's why we want to be timing our entries when prices are near the 20 MA. And let me show you an example. It's going to be a lot easier when you actually just visualize this. Take a look at this uptrend. Take a look at every single retracement setup here. This is the 20 MA, the blue line. What is it doing? It's underpriced, trending higher. It's not flat. When the 20 MA is flat, it's not effective. That suggests that prices are trendless, that their prices are sideways. We want it to be underpriced, trending higher. And notice, every time we got close or we touched the 20 MA, we bounced. And that was honestly a very good dip buying opportunity. Literally every time it hit the 20 MA, every single retracement here, 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 here. You get the idea. Every single retracement got bought. And this is exactly why I like to use the 20 MA in conjunction with everything else that I'm going to teach you in this video. Whenever I teach the 20 MA, people are like, oh, well, you're just using an indicator for your entries. No, I use it as a complement. It complements every other part of my analysis. It complements the other criteria. I use it to my advantage. I don't solely rely off of it. Here's another example of a downtrend. We base into the 20 MA, drop. Base into the 20 MA right here, drop. Retrace a little bit, we come a little close, drop, okay? That's why I like to use the 20 MA. Here's another example. And we weren't quite, right at the 20, but we're pretty near the 20. And this was actually on the 15-minute time frame. On the 5-minute time frame on this chart, we were actually right by the 20. But this was an excellent buy the dip opportunity where we moved up, retraced, and that was an excellent buying, buy the dip setup. So we want the 20 MA to be underpriced, trending higher, and we want to see prices retrace into the 20 MA or at least come close to the 20 MA. This is a very important requirement. Criteria number 4 is actually pretty simple. We want to see the stock retrace 40 to 60% of the prior move. We want it to pull back 40 to 60% of the original rally. Retracement, if you want to define what a retracement is, it's just the amount that the stock pulls back. So we want to see this pull back into what I call the golden zone. And that is between 40 to 60% of this rally, right? So let's say this was 0%, the bottom of the rally. This was the top of the rally. That represents 100%. We want it to pull back around 40 to 60% of this rally, which is like this area right here. We don't want it to pull back deeper than 60%. We don't want it in this area right here because a deep pullback suggests weakness. If that stock was really that strong, if that trend was really that established and really that strong to the upside, why would it retrace over 60%? And the same thing applies almost in the opposite way if it's under 40%. So let's say a stock pulls back here, right, into this area. That shows lack of correction. And, just through my experience, when you have a very shallow retracement where it's not into this golden zone, where it's like 20% retracement or 30% retracement, whenever it attempts to move higher, it fails because it just hasn't corrected enough. It hasn't gone through enough of a resting period for prices to continue higher. And similarly, if you see a really deep pullback into this area, well, prices are really weak. And what tends to happen is it starts to move up, you get excited, and then it fails. And that's just through my personal experience. You want to see it into the golden zone, the 40 to 60% retracement of this prior move. That's really the sweet spot. By the way, I have hundreds of hours of free education on the internet, not only on this YouTube channel that you're watching right now, but I also have a free 10+ hour trading course that is genuinely better than most paid courses on the internet. It will actually elaborate further on this strategy, and it will also teach you my other trading strategies. So you could start my free course and access it in the description of this video. And if you're someone who's looking for something a little bit more serious, you want a hands-on coach or mentor, I do personally help coach and scale traders from zero to consistently profitable, where I take my students under my wing and they trade live with me every single day. So if you are looking for something a little bit more serious, you want a dedicated mentor, you could apply for my mentorship program, also in the description of this video. Criteria number 5, before I enter into any single trade in the markets, I need a predetermined entry, predetermined stop loss, and of course, predetermined target, because that's going to add structure to my trading. I hate operating randomly. I want to know where I'm supposed to get in and where I'm supposed to get out if the trade doesn't go in my favor. A lot of traders operate completely randomly and then they expect consistent results. That makes no sense. If you want consistent results, you need consistent input. That means you need a structured approach towards entering and exiting a trade. So the entry and the stop loss for the retracement setup is actually really simple. So your entry is going to go over the last candlestick of the pullback. I'm going to show you what that looks like in a second. Your stop loss is going to go under the lows of the retracement. So you find the lowest point of the retracement. Your stop loss is going to go below it. And the target is the previous high. So where are the last candlesticks of the pullback? Well, right here, these two. So entry over these two candlesticks, stop loss below the lows of the retracement, and you're going to be targeting the previous high. That is target number 1. Now, that's super simple. And ideally, you want your entry bars, right here. These are our entry bars because we're using these bars to base our entry and stop loss off of. We want these to be narrow range bars or doji bars. We want these to be relatively small candlesticks. And the reason we want that is because it's going to give us a far better reward to risk. So how do you size your position? If you watched my risk management video, you should already know this, or if you've watched my free 10+hour course, you should know this. The share sizing formula is risk divided by entry minus stop loss, and then entry and stop loss, they're in parentheses. So you calculate this first before you do the division. So let's say our entry is at $4, stop loss is at $3.90, and our risk is $100. $100 divided by $4 minus $3.90, so that's $100 divided by 10 cents. $100 divided by 10 cents is 1,000 shares. So that would be our share size for this position. If we get 1,000 shares at $4 and it hits our stop loss at $3.90, we would lose $100. All right. Now, why do we want small candlesticks? Well, let me give you this example. Let's say this is a really large candlestick like that. Let's say these candlesticks are larger. And then all of a sudden we have a much bigger stop where instead of our stop being at 390, let's say our stop is at 370 all of a sudden. Then we have to go and actually change the formula around because our entry remains the same, right? But our stop loss is different. So instead of 390, this would be 370. So now our share sizing formula would be $100 divided by 30 cents because $4 minus 370, that's the distance between our entry and our stop, 30 cents, right? So $100 divided by 30 cents, that means we would only be able to get 333 shares for this position because we have a much bigger stop loss and therefore we have a much lower R to R. So we want smaller candlesticks, we want smaller entry bars so we can get a tighter stop, and as a result we could have a better reward to risk for, our same risk. Keep in mind with having a 30-cent stop now versus a 10-cent stop before, our risk hasn't changed. What's changed is the amount of shares that we can get so that, if the trade does hit our stop loss, right, we're only going to lose $100. So we want smaller entry bars because we have a better R to R. Criteria number 6, we want to look for a retracement into what's called minor support. This is when prior resistance of that uptrend becomes support for the next dip. So for example, let's say we are right here and prices move up. Fantastic. We want to see this next dip basically dip into the prior resistance, right? Like at this point right here, this prior high, it's going to act as resistance. That's why this prior high is target 1 because that's the next level of resistance. But on this dip, we want to see this prior resistance, this area of resistance become support. And this is a really nice amplifier where if we could have a nice move up and then a dip into what was before resistance, that's exactly what we want to see. This is a really solid area to potentially buy the dip for the next move higher. So if I draw it out, we have an uptrend, right? We have an uptrend. This is an area of resistance. We want this area of resistance to now become support, and it moves up. Same thing here, this area of resistance, okay, right here, now becomes support for the next dip before we move up. And this is a really nice amplifier, and it's really simple. Prior resistance, the prior high, basically becomes support for this stock within the uptrend. Now, before I show you some real life examples and some recent trades that I have taken where I was trading the retracement setup, I want to emphasize that you don't need every single one of these criteria to hit in order to buy the dip. And that somehow rhymed, but you don't need every single one of these qualities, right? You can pick and choose which qualities you want to put into your trading plan. For example, let's say I'm looking at a retracement setup and it's into the golden zone. Great. It's into a rising 20. Great. It has 3 or 4 red bars in a row. Fantastic. It has a nice entry. It has a really good reward to risk, but it's not retracing into minor support. I will still probably take that trade because it hit enough of my criteria. Let's say instead maybe it did retrace into minor support, but it's not quite into the golden zone. Maybe it's like right here, like 65% retracement, but it's into the rising 20. It has a really bullish catalyst. It has 3 or more red bars in a row. It has a really nice R to R. I might still take that trade, right? So you could pick and choose which criteria you want to specifically focus on your setups, because you're not always going to get picture perfect retracement setups. If you do, great, you should just take it, but you're not always going to get picture perfect. So you can decide which one of these qualities you want to include in your game plan, and you can decide which one of these qualities are like necessities versus maybe some of these are more optional for you. So right off the bat, I want to show you what a power trend is first and how you can capitalize trading retracements within a power trend. And a power trend is exactly what it sounds like. It's a powerful trend. And most of the time, you're going to see the 20 SMA under prices trending higher, and you will see it kind of trending in a 45-degree angle. When you see the 20 MA trending in a 45-degree angle, it suggests that the trend is sustainable. When you see it trending at a little bit, greater than a 45-degree angle, that's when the trend is kind of getting exhausted. And you could see this was on Wayfair just recently over the last few weeks. I mean, look at this beautiful uptrend. Every time it retraced to the 20 period moving average, literally every single time, it respected the 20 MA and then started to rally right after that. Even here, we broke below the 20, instantly rejected and continued higher. Even here, almost broke below the 20, instantly rejected and continued higher. Here's another really good example of that going both ways. Here we have a solid power trend to the downside where we dropped, retraced to the 20 MA, dropped, retraced to the 20 MA. And this is also, a retracement setup just to the downside. So everything that I taught you in this video could also be applied if you're going short. You would just apply it the opposite way, where the 20 MA is overpriced, trending lower. And all of the same criteria would apply the same exact way. So retraced to the 20 MA, dropped, retraced to the 20 MA. This time it gapped down all the way to the 200, respected it, right? Retraced back to the 20, dropped, retraced back to the 20, dropped. And then the same thing happened on this uptrend. You could see how well prices are respecting the 20 MA on this power uptrend. And every time we got a retracement to the 20 MA, we ended up rallying. We could even look at the S&P 500, which has basically been on a power uptrend since the tariffs happened in early April. And we've rallied 36% since then. And take a look on this uptrend, every single dip into this rising 20 MA got bought. We dipped right here, right to the 20, instantly moved up. Dipped into the 20, moved up. Dipped into the 20, moved up. Even here, we broke below the 20, instantly rejected, continued higher. Dipped right into the 20, perfectly respected it. Same thing here, same thing on this tail, same thing recently here. So if you're noticing that you're looking at a stock or any type of asset that is power trending and closely following the 20 SMA, you could actually use every dip into the 20 SMA as a buying opportunity, especially if it matches up with the other criteria that I have taught you. Let's look at some individual retracement setups that we can understand and analyze. So the first one is plug. We already looked at this gap earlier in the video, but this gap from 284 the previous day, and it opened around 13% higher at 321 the next day. It was gapping above a red bar, and it was also gapping above resistance. So this was a really bullish gap, and this gave me a bullish bias for the day on plug. From there, we go to the smaller time frame. So I like to use the 5-minute chart, especially around 30 minutes into the day. And funny enough, I will be honest, I actually got stopped out on plug because I originally tried it as a breakout here. I was super aggressive. It was extended from the 20 MA, so really aggressive setup, and I took a full stop on this. And funny enough, right after that, I called this as a retracement setup, and I had a lot of my students actually take this play and make money, but I ended up passing on it. And then looking back at it, it was just a beautiful retracement by the dip opportunity, but I already kind of took a stop on this, so I stopped watching the plug and I started focusing on other stocks. But wow, what a setup here. Really nice pullback. We had 3 or more red bars in a row. We did have one doji, but it's never going to be exactly perfect. So nice pullback into the rising 20 MA. I would call this a 40 to 60% retracement, right? Maybe 60%, 55%, something like that. But we're into that golden zone. Perfect. We had a gap up, so we can't really look at minor support. So, that criteria doesn't really apply. And the entry would go over these candlesticks, over 345, stop loss around 335. So it was a 10-cent stop, and this ended up moving all the way to 392, which is around a 40 to 50-cent gain. So this was like a 4 to 5 hour trade, it would have been. And maybe you took profits at target 1, and then you left a runner, and maybe you took those profits somewhere up here, but really nice retracement setup. And obviously I didn't take advantage of this, but I had a ton of students who did. And yeah, this is a really great example of a bullish gap on the daily time frame, and then you trade that bias via a retracement setup on the intraday time frames. Let's look at another example, and this was on Rumble, and this was also just a few days ago. This was just this past Friday. This was the same day that the plug happened, and I know that because I actually called this trade in my group, and this stock gapped from 739 to 823, which was an 11% gap up. So that gave me a bullish bias for the day because we were gapping above this resistance. And the next major resistance was honestly the 200 period simple moving average. So I thought that this stock could actually run up to around $9 for that day. And I go to the 5-minute time frame, and we'll look at the other time frames in just a second here, but we get a beautiful retracement setup. We get a nice move up, 4 red bars in a row. Perfect. We don't see any Christmas lights. We are kind of far away from the 20, but you got to keep in mind, because of the big gap up, it's going to take time for the 20 MA to catch up to prices, but it's still rising. It's still under price. And the entry would be over this red bar, stop loss directly below. And we would enter this trade basically as this green bar is forming. We don't wait for this green bar to finish forming and then take it. As soon as it hits above this entry, above, 833, we would get into the trade. So you don't need to wait for this green bar to actually finish forming. And this was kind of a deep retracement, maybe a little bit above 60%, but still really nice retracement setup. And of course, TP1 would have been this prior high. And then TP2 would be the next target, which I said was around $9, and we hit around $8.95 on that setup. If you look at the 15-minute, it looked really, really solid too. So I always like to look for multiple time frame alignment. We had a nice green bar, red bar, and a nice doji bar. I like doji bars, right? So entry above the doji bar, stop loss directly below. So you could have taken this retracement setup also off the 15. And by the way, we kind of got one, later in the day. Even though I didn't really like this one, it was a really deep pullback. But hey, if you wanted to trade this retracement setup right before the close, you could have entered above this little base, above these candlesticks, stop loss directly below. Let's look at the RKLB, Rocket Lab Corporation. This was a few months ago, but I remember taking this trade, and this was just a fantastic retracement setup. We had a very minor gap up from 25.40 to 26.65. So we were just clearing above this resistance. And that small little gap up actually gave me a bullish bias on the day. We were clearing above this resistance, and I thought we had upside to move higher until this prior resistance area. So we go to the 5-minute time frame, all right, and we got a really nice retracement setup here. Green bar, we got one big red bar, then a small little kind of topping tail, narrow range bar, right? So entry above, stop loss below, and obviously this had really nice follow through, but I think this was actually way nicer on the 2-minute time frame. So I always like to look at multiple time frames, and that gives me a lot better of a perspective on what that stock is actually doing. And as you can see on the 2-minute, it was actually much nicer. Nice move up, red bar, bottoming tail, and then we had like 2 doji bars in a row. Really nice. So we didn't see 3 to 5 red bars in a row, but it didn't matter because it was still a really nice retracement setup, entry above, right? stop loss directly below. And you could have even entered it here. Let's say you missed this setup and moved up kind of based. You could have put your entry here, stop loss directly below. I would say this would be a little bit tougher because it's right into the prior high. But of course, it didn't matter. It continued up, and even here had a nice little retracement setup. Moved up, retraced 3 red bars, bottoming tail. You could even played this. I wouldn't have, and I didn't. But, in theory, this is also a retracement setup. Entry there, stop loss above, and you would have taken profits at the previous target. Let's look at another one, and this was on APLD just a few months ago as well. Terrific trade that I called and actually executed on. And APLD had a nice move up, retracement, almost had a retracement setup here into the rising 20, 4 red bars in a row, and it triggered this retracement setup on a gap. So we gapped up, triggered that setup, and of course we had really nice follow through to the upside, and I traded it on the day of the gap. So this gap was gapping above those 4 red bars, above resistance. I thought it was really interesting. It gave me a bullish bias on the day. And if we go to the 5-minute time frame, we got, basically a picture perfect, retracement setup. Nice move up, 3 red bars in a row. Then we had a bottoming tail, narrow range bar, close to the 20 MA. Okay, around a 60% retracement or so, a little bit more than that, but still really nice. And entry would have been over that candlestick, stop loss directly below. And of course it hit target 1. It actually exceeded target. In fact, we kind of got another retracement here and another retracement setup here that you could have played. So really nice setups. And even though it didn't hit every single criteria, it's still an effective setup because we combined the daily time frame and looking at the gap and establishing that bullish bias. We knew that there was a bullish direction, there was a bullish catalyst, and we combined that catalyst with a retracement setup on the intraday time frames. Let's look at some retracement setups that actually work the other way, that actually worked as shorts. So this stock gapped from 2022 to 1888 the next day. So this was like a 6% gap down, but notice how it was gapping below the 200 and below a lot of this resistance. So really bearish gap down. I had a bearish bias for this stock on that day, and we got a picture perfect, almost power trend lower. But take a look at this retracement. We moved down. We had 3 green bars in a row. Remember, we want 3 red bars if we're looking to go long. If we're looking to go short, we want 3 green bars in a row, 40 to 60% retracement into the golden zone near the 20 MA, so nice. And entry right below these candlesticks, stop loss directly above. And then literally every single time it retraced near to the 20 MA, it actually just continued lower. So beautiful, picture perfect retracement setup. In the opposite direction where we would be going short instead of long. So all the criteria that I just taught you, it would just be the opposite if you're going short. Let's take a look at the FNKO, and I remember the setup very clearly because I couldn't get filled on it, and it was an unbelievable trade, but I couldn't get filled any shares short on my Thinkorswim. I just couldn't get a fill, so I couldn't take advantage of it. But this was gapping from 365 that day to around 298 the next day, around 18% gap down. This stock had a nice move down, based, and it triggered this breakdown via a gap on the daily chart. So I had a bearish bias going into this day. And if we go to the 5-minute time frame, we could see a beautiful, just beautiful retracement setup right here. It's a little bit choppy because TradingView doesn't really represent this data all that well. But we had a nice move down, 40 to 60% retracement, not a perfect retracement, but it was still good enough to take. Near the 20 MA, right? 20 MA was starting to catch up to price. And basically the entry would have gone under 264 or under 265, stop loss 275. And it was a 10-cent stop, and this thing dropped all the way to 232. So unbelievable trade. This was actually scalpable as well. Really nice retracement setup for a short. And in fact, it worked as a retracement here. It retraced to the 20 MA, kind of based, dropped. Retraced to the 20 MA, dropped. But at this point, it formed a higher low. So, that's obviously a red flag, and it obviously started to kind of transition higher after that. But beautiful retracement setup to the downside. Like I said, entry under 265, stop loss 275. And if you look at the 15-minute, look at that. Really nice. Nice move lower. Couple of green bars. We had a doji bar here and beautiful continuation to the downside. Hopefully you found tremendous value in this video, and I want you to actually test this strategy first in your own trading with either paper trading or really small risk, so you could develop a feel for trading the retracement setup, and you could practice applying all of the criteria that I've taught you today. All right, before you actually use significant risk, I want you to test it out. I want you to kind of develop your own intuition for this setup and be selective with your trades. Don't just take any retracement. I pass on like over 95% of the dip opportunities I see in the markets because I only like to go for high quality A+ retracements. So make sure you're paying attention to these criteria and make sure you're practicing this setup before you actually use heavy risk. Let me know in the comments what you think about this strategy and whether you think it's going to be very effective for your trading plan. Make sure you leave a like on this video and make sure you subscribe to the channel for my other education. And lastly, make sure you get started with my free 10+ hour trading course. Like I said, it is genuinely better than most paid courses on the internet, and you're going to find that out, and you're going to learn more about this strategy in my free course as well. So I will see you on the next video. Thank you so much for watching.